The question that I often get many times is, okay, how do you overfund? What does that look like? And we're going to be looking at the cash flow way to overfund. So this relates to if you have cash flow, maybe you have a couple assets that you want to strategically dump in, but then ultimately keep this thing going with cash flow. This is our more popular, more common strategy. And I'm just going to show you the difference in every company. I'm just using one company that we work with, but every company is very similar, and I want to explain to you the importance of overfunding. So I am here on illustration software. I'm assuming just random persons from Colorado. We'll just do a select rating, and we're going to say that they're 35. And the first thing that I'm going to do is I'm going to go in and I am going to put in $10,000 a year. Okay, now this could be $100,000 a year. This could be $5,000 a year, whatever the amount is. I'm putting that in. I'm going to go 1 to M. This stands for maturity. So 1 till the end, and I'm not going to put any riders on. Okay, so this is the first scenario, and I'm going to show you the quick view. In the quick view, we're going to go non-guaranteed cash value because that's just assuming that the dividends and interest, we'll just go off of that. The first 2 years are zero. Like the first 2 years in this plan is zero cash value. Year 3, you've already put $30,000 in. You have $6,972. You look at 10 years, you're $100,000 in. You have $85,000 for the cash value. Again, pretty good. And go 20 years out, you're $200,000 in, you have $36,000. So you can see long term, this is beneficial. Look at the death benefit, you have $987,000. So pretty much you have $1 million worth of coverage, and it slowly goes up. You can see in the first couple of years, the death benefit doesn't increase. So this is with a great company. This is a dividend paying contract, but it's not being overfunded at all. So notice the death benefit, and notice the lack of cash value in the first couple of years. Now what I'm going to do is I'm going to overfund with a rider. So I'm going to go in and I'm going to say, we're going to, we're going to max fund. We're going to max fund for the next, 30 years. This is one way to do it. There's other ways to. I'm doing a very simple explanation. There's obviously different strategies that we can look at. But when we overfund, what we're doing is we're buying less death benefit, but we're overpaying. Instead of almost having $1 million worth of death benefit, now you have $422,000 worth of death benefit. Look at the cash value. Your cash value is, $5,761. Okay, that's a cash value early on. Year 2 is over $11,000. Year 3, you have over $20,000. And if you look at over, a 20-year period, you're putting in $200,000. You have $285,000. And remember, there's a lot of other benefits. This money is going to continue to grow the rest of your life. So both plans had long-term growth, and that was good. But the big difference is the cash value wasn't being super efficient early on. And also you have tons of flexibility because in this plan, the base premium is $4,046. That means any year you want to pay less, you can go all the way down to $4,000. And I'll say another thing is, in the early years, you have cash value. If something happens to you and you're not able to pay the premium at all, it's common to borrow against the cash value to pay the base premium, worst case scenario. So these are extremely flexible. They're extremely flexible when you overfund. It gives you less death benefit, but it gives you higher early access to cash value and gives you flexibility. And this is just, again, a plain vanilla 30 years. Now, there are people that come to us and they're like, we have a lot of assets that we have, but yet we only want to, save $10,000 a year, but we have, a good chunk of change that we want to get in earlier. So let me share with you another design that we could do, and the design pretty much goes like this. What we're going to do is we're going to put in $50,000. We're going to do $50,000 for the first 5 years. Then we're going to drop it down all the way to the base. This is another way to design the policy, and it can be very, very effective. Okay, so what I'm doing here, putting in $50,000 for the first 5 years. You have over $35,000 worth of cash value. It's pretty significant it's like 70% first year cash value. The minimum payment on the first 5 years is $13,715, and then once year 6, now this is what you're paying, $13,715, and you can pay that all the way till whenever you want to stop. You can do what's called a reduced paid up or whatever. But look at this. If you're paying $13,000, let's just say $14,000. Look at how significant your cash value is increasing every single year. So a lot of people that use this strategy go, once you get this in place, why would you ever want to stop? It's one of those things that it continues to get better, ongoing, and we're going to see the reports. But like, if you can get your money to grow the rest of your life, if it can, look at the death benefit, it increases the rest of your life. You're also able to access this capital to access the rest of your life. It's just, again, it makes sense to do this. And so this is what I encourage you to do when you're working with your coach. I encourage you to understand at least enough to like what's kind of going on, but ultimately figure out what kind of assets and what kind of cash flow that you have that you want to put into a plan like this. And then what the coach is going to do is we're going to figure out the most efficient way to funnel that into a life insurance policy, ultimately overfunding, to make sure that your dollars get the maximum value not only today, but in the future. And this is just a perfect example that you have a great company, but if you don't structure it properly, it's less flexible, it performs worse, and ultimately you're just buying expensive life insurance. So that's a quick overview on just numbers, and hopefully it's been enlightening.